Well, I think I would to some extent back that up. It depends where it goes. But Trump's already been very clear on telling OPEC, come on, pump more oil, the oil price is too high. This will increase the pressure on Saudi. He showed in his press conference yesterday he worries about jobs. He says, well, I don't want to stop any arms sales that may lead to lower jobs coming up to the midterms. So one would expect that we're moving, the leaks are coming out, we're moving towards something where there's some sort of agreement where they can blame someone else and Saudi pumps more oil. I think that's a potentially valid outcome. But again, wait and see.
We just want to mention, just update on the Saudi blue chips, the total oil index as well, which in the previous session had a 4.14% rally. We understand that we've seen some significant declines yet again at the start of trading. So nerves re-emerging on the Saudi index, falling. I think we've seen a handle of just over 3% on that one as well as we speak.
Just to come back to David, I mean, this is one of a number of potential macro headwinds now that the risk-on crowd are facing. We've had a bit of a wobble and a shakeout, particularly on the growth equity space. Yep. What happens next? Are any of these issues sufficiently important to actually lead us lower into the year-end close?
Well, I think what will happen now is what always happens. It will come back to what are we seeing from companies, what are earnings like. So most of these issues have been around for a long period of time, whether it's Trump or trade or China or Italy or oil, whatever it may be. They've always been around. The market's done okay most of the year, and then we had actually much higher interest rates than expected thrown on top of that. And I think that caused investors to sit back. Okay, so what are we willing? We've been willing to pay a lot for very high growth stocks. With higher rates, is now that the right thing? And we sit back and think. And we've had a sort of a reassessment of risk and growth and what we need to pay for it.
Leverage. It's something which, thank you. Perhaps it's ESP going on today, but I'm a broken record, and like a stopped clock every now and again, every 10 years or so, I'm right. 1998, 2008 were two of those times. I worry considerably about leverage, about household, about corporate, about what corporates have done with the money they've been given, with the profits they've earned. In fact, what they've done is create buybacks in many cases, well, rather than some form of longer-term, lasting legacy which is going to boost capital. But that's not my point now. My point is leverage in the tightening environment. It was also your point, I believe.
Yeah, exactly. I think that's a new thing. The leverage has been there for a while. It seems slightly surprising we have more debt now than we had in 2007 when
significantly
that was a debt-driven crisis.
Everywhere.
But with interest rates very low, that's been actually manageable for everybody. And I guess as we see rates move higher, whether that's short rates or along the curve, then that increases that pressure again. It's made everyone think again about, well, okay, what are we paying for these businesses? Whether it's by leverage or whether it's the growth, is that sustainable in the future? And that's what the market's looking for. What's the next impact?
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.